Without further ado, please give a warm hand to both gentlemen, Mr. James Bullard and Mr. Kaushik Basu.
If you, in the olden days, when I was a student in London, went around and asked economists, why don't people pick other people's wallets, pickpockets, in traveling in buses or sitting in a group like that, why don't people steal other people's wallets? The answer by economists would be given in terms of pure rational calculation. People don't steal other people's pockets because if you take away another person's wallet, you may get $100, $200, but you can get caught and then you'll be punished $2,000. And that cost is not the reason why you don't pick other people's pockets.
Right.
But that was, to me, a brainwashing of economics. Just think for a moment. If that's the reason why we don't steal other people's wallets, then sitting in a room like this, you'll feel very uncomfortable if you know everyone is calculating whether it's worthwhile stealing your wallet or not. We feel comfortable because we know that in most places, most societies, we don't even go through that calculation. Human beings have norms of that kind all over in life, and we've made too little room for that. When in the World Bank, we for the first time started discussing that we should bring in these non-rational, behavioral, psychology-based analysis into the modeling, there was a lot of criticism that, look, is this really a domain where economists should go in? To that, again, my response was with an example. The private sector already makes use of individual irrationalities in a huge way.
Yeah.
And given that they are doing that, for the development set, for government, for central banks, to understand human systematic irrationalities is important. And the specific example which I used, which you will get it in the United States very often, and maybe even in the Netherlands. Suppose you're going to buy a refrigerator, and you go to a shop which sells only refrigerators. Often in the United States, when entering the shop, you'll see one refrigerator which is fantastic, exactly what you wanted, every facility, but very high price. You stand there and you wonder whether such a high-priced refrigerator is worth buying. People typically will not buy. In fact, if you check with the store, you will discover that that refrigerator, that kind of refrigerator, is never sold. Why do they have the refrigerator over there in front of the store? Because after you look at it and you go in, your pricing mechanism in your head gets changed. Then you'll buy another very expensive refrigerator because your price reference has been changed. Private sector uses these kinds of techniques all the time. Giving mortgages, you use that. We should use that for development purposes, for good purposes, for getting people to take education, for getting people to buy health support. So that was the idea with which we produced this report called Mind, Society, and Behavior, which is really quite a move away from very traditional economics. But after we produced the report, the buy-in has been huge, and it's been very satisfying to have produced that.
Brad, does it have to do with the austerity being implemented in the Eurozone and maybe the Stimulus Act in 2009 in the US, where they promised more than 800 billion over 10 years? How do you think that the US is further ahead because they've had more stimulus as opposed to the austerity measures being taken in the Eurozone?
Well, this is a great topic. I think that in the U.S., the response to the crisis was very aggressive monetary policy. We undertook unconventional monetary policy sooner and in larger measure than it was here in Europe. And I think there's a very good reason for that. The ECB is a multilateral institution, and frankly, I think the leaders at the ECB were not sure that they really had the mandate through the Maastricht Treaty to go ahead and do these kinds of unconventional monetary policies. So that led to a protracted debate on whether the ECB should go ahead with unconventional policy or not. And eventually that has come out as they will, so they have in the last year, but that much later than when the Fed did it. So what you got in Europe was a double dip recession, and what you got in the US was a huge recession, but just a recovery from that big recession. So I think that's the fundamental difference, and I think there are good, good reasons behind that. On the austerity question, in textbook models, when we do government spending in reaction to a crisis, we always start out with the debt levels are zero. Or something like that. So the problem, I think, in Europe is that countries started with very high debt levels, and now the crisis came along, and now you had to go like even higher, and there are limits to how much of this you can do, as we found out. And you got countries that breached those limits and started to call into question whether they could really pay back all this debt or not, and that led to the crisis and the double dip.
And I actually agree with that, and let me add in something on austerity, which doesn't go into micro foundations, but just on that. You know, one of the very interesting things, if you look at the Eurozone, is in 1999, when the euro comes into existence, there's a monetary union, something very strange happened across the Eurozone countries. Borrowing money. When your Greece is borrowing money or Germany is borrowing money, certainly from 2001, Greece entered Eurozone a little bit later, from 2001, all of these countries are borrowing money at the same interest rates. Before that, Greece would be borrowing at a much higher interest rate because people considered Greece to be riskier than Germany. Ireland would be borrowing at a higher, Portugal at a higher, Germany lower, France lower. By 2000, 2001, they are borrowing at the same interest rate. So the creation of the monetary union created a bit of an illusion that it's also a fiscal union. And all the way up to 2008, the interest rates at which they are borrowing is virtually the same. 2008, Lehman crisis comes, and the borrowing cost again differs hugely. Greece shoots up, Germany goes down a little bit. What happened was, to my mind, this period from 2000 to 2008, there was over-borrowing in some countries, so that largish debt that you're seeing by 2010 and 11 happened during this period. And my view is, yes, you don't want to have a sudden austerity and try to change that. But in the medium term, there has to be austerity because for this big debt buildup that has taken place, that needs to be corrected at some point. So it has to be a nuanced